All right, so now let's shift gears to equities. We'll have kind of a similar discussion that we had for debt, but now focused on equity. All right, so let me just begin by defining this. Equity securities or stocks represent ownership in a corporation. Common stockholders are residual claimants, that's what we call them. What does that mean? It means they have a claim on all cash flows only after all other claimants have been paid. So employees, suppliers, debt holders, government, and anyone else who has a legal claim to something from the company, they have to be paid off first. So any money that's left over, then the shareholders get. At any point in time, the market value of a firm's common stock depends on many different factors. So including the company's profitability, these are the cash flows that we talked about in lecture 1. The company's growth potential, that's another critical factor that causes us to think about what the value of the company is or the value of the stock is. Current market interest rates, this is what we use as our discount value, for example, and other factors. All right, so I want to just take a moment to talk about stock markets, because the markets that stocks trade in really are an important piece in finance, and they help us determine what an appropriate value is for stocks. So if these things aren't working properly, then it can lead to some very misallocation, very skewed allocation of resources in society. So stock exchanges or stock markets provide liquidity, right? The ability for owners of common stock to convert their shares into cash at any time. Liquidity allows buyers and sellers the means to transact with each other, and it gives people the confidence to buy and their shares in the first place, and it creates what's called price discovery. So some examples of the big ones are the New York Stock Exchange, the NASDAQ. That's where Microsoft and Google are traded. The London Stock Exchange is a big one in Europe. And then there are all the major banks have what are known as private trading floors. So the largest private trading floor in the world is at UBS, which is a Swiss bank, and located just outside of New York City in Stamford, Connecticut. Just to get a sense of what this is their trading floor. It's the size of a couple football fields. And actually, your instructor sat roughly right there I spent a few months there back in the summer of 2000 doing a project. And actually, what's interesting is this is broken out by type of security. So this whole back half is, I believe this was different equities. And then you had different bonds. And then you had foreign exchange. So I was in the foreign exchange area, for example. And then within each of these, there are broken out into, divided into more finely tuned areas. So this is a beehive of activity going on, and all the major banks have something like this. Okay. Stock valuation. That was really the heart of our conversation for bonds, and it's really even more the heart for stocks. So we like to use our TVM tool to value stocks, right? We used it for bonds. Why can't we use it for stocks? So, for example, when we valued bonds, we discounted the promised future payments of the bond by an appropriate interest rate, right, our discount rate, and we concluded with the present value of the bond price, the current market price. So, we'd like to do that for stocks, but there's a problem. Unfortunately for stocks, the issuer, the company whose stocks we want to buy, they haven't promised any specific payments. Right? We're just residual claimants. So it's not obvious what values we should use for our future cash flows, right? The numerator of our time value of money analysis. We don't know what we should use. Right? For bonds, we knew. We had that timeline. But for stocks, we don't. So this makes it much harder, actually, to value stocks compared to bonds. But it's not impossible. If it were impossible, then I wouldn't have put this lecture here. So let's just take a first cut at stock valuation. Let's say we're trying to value a company's stock in which we expect a dividend to be paid. Not all stocks pay dividends, but let's just say in this case it is. We can look at historic dividend payments to get a sense of how much the dividend in the future might be. Right? We'll use the past as a guide to the future. So let's assume that the company is mature and the dividends are expected to be about the same, forever. There's really no change. These are likely to be oversimplifications, but that's okay. This is a first cut. So if we assume a dividend, let's just say the dividend is going to be $2 based on our historic analysis. Then what we're really saying is every year we expect a $2 dividend payment for each, for one share of the stock. And we expect that forever. So a $2 dividend, what that is a $2 dividend payment in perpetuity. In year 1 we get $2, in year 2, $2, year 3, $2, and so on. Valuing this then is simply valuing a perpetuity, which is something we did and saw in the time value of money analysis. It's just the present value of the perpetuity is just the annual payment divided by the discount rate. We don't do divided by 1 plus the discount rate raised to some power. It's just divided by the discount rate. So let's just assume a discount rate of 12%. In this case, the present value is $2 divided by 0.12, or 12%, which is $16.67. So the value of a stock that pays a dividend of $2, where we expect the dividend to be $2 forever, in perpetuity, we'd be willing to pay $16.67 today for that stream of dividend payments. We can call this is often called the dividend discount model. Right? We're just discounting the dividends. So we can build on this model. This is it's actually, we went from having no idea how to value this thing to actually coming up with a value based on a couple of very reasonable, although simplifying assumptions. So that was a pretty good first cut. So we can build on the model a little to make it more versatile. So for example, we might assume that this is an established company, but it's growing. So if we can estimate or make an assumption about the growth rate, maybe we can update our analysis. So let's just say it's a constant growth rate, and then we can use the equation that relates to a perpetuity with constant growth. Now in this case, the equation would be the dividend this year times 1 plus the growth rate, and then we divide that whole thing by R minus G, or the discount rate minus the growth rate. And that's just the formula for calculating a perpetuity with growth. So let's just plug in some numbers, say our growth rate is 3%, and then we have $2 times 1.03 divided by the discount rate minus the growth rate, 12 minus 3. Make sure, if you've got percents, make sure you don't mix, you don't add extra decimal points somewhere, otherwise you're going to get the arithmetic wrong. And if you're doing this in Excel, make sure that you have parentheses around the right areas, otherwise you're going to get the arithmetic wrong. But assuming we get the arithmetic correct, the calculation is actually pretty straightforward. So this reduces to $22.89. We would be willing to pay $22.89 today to receive a perpetuity with a growth perpetuity with the characteristics, where it's $2 growing at a rate of 3% forever and applying a discount rate of 12%. So let's just compare these two. When it was a constant dividend, the value today was $16.67. Right, one share of the stock was worth $16.67. When there was a constant growth rate applied of just 3%, the dividend, the stock today was worth $22.89. The growth assumption gave us an extra $6.22 per share of value, right? Which is, or 37% more value, right? $22.89 is a lot bigger than $16.67. So the conclusion is growth is good. And this is actually why company managers are constantly trying and encouraged to grow their businesses, because it shows up in stock prices like this. And if your growth rate is only just a couple, 2 or 3 or 4%, it has a huge impact in the stock valuation. So from the perspective, I say 37%, but actually, if you look at it from the perspective of a non-growth company, 1667 to 2289, that's almost 50% more. So growth, this is why there's growth built, the goal of growth is built into the private sector. So there's a lot of extensions in this basic model. We can really make it very robust, all from this pretty simple model. But the essential ingredients involve what we just saw. So we can, in this case, we estimated a dividend and we estimated a growth rate and a discount rate. But some of our common extensions is we split them into 2 time horizons. So we have a high growth phase in the early years. Maybe the first 4 or 5 years grow really fast. We can actually specify what they're going to be. And then after that period, there's a slow but steady growth phase, pretty much from then on out. And a lot of companies, especially new companies, follow this path. Maybe it's 5 years or 10 years of high growth, followed by more of a slow and steady growth. And that's all that is. We just value each period separately, and we use the prior methods and just add them together. Alternatively, we saw in module 1 the free cash flow is a favored way of understanding how much cash is available for using to pay back our lenders and investors. So what we'll do a little later in the course is we'll actually use the free cash flows instead of dividends. So we use this same kind of analysis, but in place of dividends, we put free cash flows. And we use that in our time value of money. So you can really, and you can add on lots of bells and whistles, but this is the basic idea. All right, so some conclusions with equities. All right, if there's any residual value after paying back all outstanding obligations, payroll, taxes, loans, etc., that residual value is owned by the shareholders. All right. Equities are bought and sold in stock markets, just like bonds are bought and sold in bond markets. We can value stocks by taking the present value of any future estimated dividends, accounting for growth, and using an appropriate discount rate. And we could even say the discount rate then, this model can then be extended based on more nuances of the details involved in the valuation. And that's for future lectures. All right, thank you very much.